Hello, I'm Christopher Wagstaffe. Welcome to the first of 29 Bedford Row's online family law specialist area discussions. I'm joined today by two of my colleagues at 29 Bedford Row, Lynsey, Cade, Davies and Miriam Foster, and we're going to be discussing some of the issues concerning business valuations that arise during the course of financial remedy proceedings. I'm delighted to say that we're joined to help us across this difficult terrain by Sally Longworth, Principal of Independent Forensic Accounting Practice, Longworth Forensic Accounting. Sally, thank you so much for joining us today.
Thank you.
Later, I'll be discussing some of the issues that arise where the court is likely to require an historic valuation of a business, the sort of thing that will assist the court where one party wishes to assert that the value of assets he or she brought into the relationship should be reflected somewhere along the line in the overall award. Miriam will be picking up on some valuation issues that have been discussed in some of the recent authorities, but we're going to start by looking with Lynsey and Sally at some of the problems encountered by forensic accountants flowing from COVID-19 issues. Lynsey.
Thank you, Chris. So we hear time and time again that the purpose of a company valuation is to assist the court in testing the fairness of a proposed outcome. And we all know the phrase that the valuation exercise is an art, not a science. And that valuations of private companies should be approached with caution. There are, as we all know, different methods of valuing a company. There is the net asset basis, earnings basis, or market value based on the value of similar companies. For today's purposes, I, along with Sally, are going to focus on the earnings and market value bases and leave net assets to one side. Company valuations have been described by the courts as among the most fragile valuations which can be obtained. And I'm sure the current climate is no different. As we emerge out of lockdown restrictions, albeit that emergence from those restrictions seems to be delayed time and time again, I'd like to explore with Sally just how fragile those valuations are in the current climate. Sally, in particular, at the moment, we're finding that the single joint expert reports we receive all contain the caveat, which I'll summarise as follows. COVID is exceptional, so don't sue me if I get this wrong. Is that a caveat we expect to see going forward for some time, Phil?
I think we've got a lot more twists and turns ahead of us in the COVID crisis. We've obviously got threats of a potential another wave in autumn. We've got the danger now of the Delta variant, which has sort of suppressed, I think, the enthusiasm that came through with the success of the vaccine. And I think until those issues are resolved, then there is going to be issues with valuations, and probably the caveat is going to remain. At least in the medium term.
And is that a blanket caveat that we can expect for all types of businesses? Or are there some where you're beginning to feel more comfortable in providing a firm valuation?
Yeah, I think there are definitely some that would be comfortable with a firm evaluation. I think it all depends really on the sector the business is involved in, but also on the level of debt and the structure of the business, and even on individuals within the business. I think there's large contrasts. I think after the initial lockdown, we saw some businesses such as the construction sector completely closed, but now it's operating quite successfully within the COVID environment and is doing really well. So I think there are certain businesses now that are now operating almost back to normal within the current COVID environment. And I think we can put a lot more weight on the value we put on those than on the companies that are suffering.
Okay, and we have a situation where the majority of companies have availed themselves of government grants and COVID loans. How are you factoring those loans or grants into your valuation exercise and the ongoing impact of the repayment schedules, I suppose, for those loans into that exercise?
Yeah, I think it's potentially a huge problem to a lot of businesses. Not only were they able to make delays in their existing financial arrangements, but they've also taken advantage of, there was a VAT deferment, they've taken advantage of furlough payments, which are going to come to an end starting from July. They've taken advantage of the COVID loans. And the issue is that they've become much more highly geared than they were before. And there's going to come a point where that finance has to be repaid. And that's going to be a crunch time for the businesses, especially if they haven't been able to recover fully from COVID at the time those repayments have to be made.
And have you found that the companies that have availed themselves of these grants and loans are the ones that are actually in need of it?
Some of them are desperately in need of it, others not so. We've seen businesses taking advantage of, rightly or wrongly, the initial COVID grants, and those grants have gone straight through the business and out as dividends at the other end. We've also seen companies take advantage of the benefits of a COVID loan compared to finance leases. So where they were going to refinance their vehicle fleet, they've used a COVID loan to fund that.
So in some circumstances, the very fact that a company has taken these grants or loans doesn't necessarily mean that it's in dire need. It may in fact demonstrate some confidence in the company's ability to continue to trade.
Yeah, I mean, effectively, it's cheap cash.
What do you consider has been the impact of the last 18 months on the valuation process itself?
I think we've had to be, I think businesses have become much more volatile. The circumstances change pretty quickly. And so we've had to take a much more granular approach, I suppose, to looking at the business activity over the last 18 months. So looking, so breaking it down really onto a month by month basis and trying to match how a business has fared in each stage of the COVID process to date.
And does that mean, therefore, a much greater reliance on the kind of company data than you previously would have done?
I think it's, I mean, in any valuation, you would be looking at what are the risks of that business and how the business is addressing those risks. And I think now COVID is obviously a key risk, and particularly not only just the ongoing trade, but its ability to service any debt it might have accumulated because of COVID. So it's a case of focusing our attention on those specific risks.
And obviously, we expect to see the owners of businesses protesting about the adverse impact of COVID on the business. And how do you test those assertions against the reality of what's happening on the ground?
I think, I mean, in any valuation we do would really ask for a COVID narrative from the business owners to actually understand what they say the impact of the business is, and then it's really testing that against the reality of the business. And that's really, again, is going back to what I said about this granular interpretation of the accounts. So, looking in much more closely how the accounts or how the profit has been produced over the last X number of months.
So, Sally, is that where we expect to see more reliance on the management accounts than on the annual company accounts?
I think, I mean, we would always rely on the management accounts, usually because they're the most up-to-date financial records that the company can produce. But I think it's really drilling into those management accounts and the substance of those accounts, and looking particularly perhaps at the order book in a much more detail than we would normally have done to see what the business is projecting to do going forward and what work it's got in its banks.
And Sally, does that mean that the conversations that you have now with the key players in a business are more important, or the content of those conversations have changed as a consequence of COVID-19, so that you can understand what they're doing to make the business work and almost to get a sense of your confidence in their ability to keep the business on track?
I don't think that they're any more important than the discussions we'd ordinarily have, but it's obviously a key area. And interestingly, it's an area that's impacting every business in some way across all sectors. So it's been very interesting to be able to compare different businesses' approach and different businesses' explanations for what's happened.
There must be times when you get an explanation of something from a business owner and you think to yourself, pull the other one, it's got bells on it. To what extent, A, do you think that that's the job of the forensic valuer rather than the court? And B, are you seeing more or less or the same of that sort of thing during the current COVID difficulties?
I think the natural way is for the business owner to try and downplay the value of the business, and we're always aware of that. And so we would always try to look to challenge the veracity of what they're saying by looking at the underlying records, looking at the sector, how the sector's operating, and where we do, where we see something that's wrong. Yes, I would challenge it, because I think that in order to get a valuation of the business, if I think I'm being told something that's incorrect and I've got evidence to support that, then I would have to include that within my report.
Mm-hmm.
Are you finding that the process is more time consuming than it was before COVID?
I think it probably is, because we're having to take a greater depth look at it. It's what I said before. It's a granularity of the accounts, and looking really into a lot more detail than you would normally to look at trends over the 18-month period.
And obviously, in terms of all the kind of granular detail you're referring to that you need to look into, is that leading to more costly reports, or are you still managing to keep your charge out rates the same?
I think, to be fair, most of our fees are already fixed before we come to do the valuation reports.
Fair enough. And what do you consider to be the key considerations now for valuing the business that perhaps might not have been as important before COVID-19?
I think there's a general need to look at the cash flow implications of COVID on every business, and to make sure that it is a going concern. You know, it may well still be profitable, but once those debts that have been taken on kick in, can it actually afford to pay those debts? And that goes also to when we're looking at the liquidity of a business.
So are you expecting, therefore, if an owner is professing concern about the future viability of a company, are you expecting to see detailed cash flow projections to kind of validate that?
If the business has serious cash flow issues and it foresees them going forward, and it wants to trade through that, then I would fully expect it to have some sort of cash flow forecast analysis projections.
And how important is your confidence in the management team and its kind of historical ability to withstand pressures or storms of this sort?
I think it's very important. I mean, I don't think we can compare this crisis to sort of, say, the 2008 crisis. I think it's something that's sort of evolving as in sort of day by day almost. So I think, you know, sort of the experience of the management team and the stability of the management team is important, and that also goes to the stability of a company and its stage of development.
On the point about the management team, when we're looking at the earnings figures, we often see an adjustment for a market salary and a market rate for the directors or the board, as it were. Are you finding any differences to those sort of market rates now following COVID, or are you seeing that the management team have taken pay cuts in order to support the business going forward? Is there any difference really to what you're seeing in that respect?
Yes, I mean, we are seeing management teams taking pay cuts. Dividends are not being paid, you know, partly because there isn't the cash available in the businesses. In terms of market rate salaries, I think, if anything, at the moment, there is a trend for increases in wage costs, and particularly among skilled tradespeople within businesses, and that obviously has a knock-on effect from the management upwards, because there is a shortage of skilled labour.
I think we're going to come on to some Brexit-related issues later, Sally. So we'll come back to this probably. But just on that point, to what extent are you seeing an exacerbation of those difficulties that you were just talking about by Brexit, if at all, or by contrast, is the situation actually getting easier, notwithstanding Brexit?
In terms of staff?
Yeah. Mm.
I think, I mean, the situation seems to be getting worse. I think as we ease out of COVID and the market looks to recover, they're finding that there are key staff shortages. If you look at the construction sector, healthcare sector, and obviously the hospitality sector, because a lot of people, because of COVID, have looked to find employment elsewhere. And now, as the hospitality sector is trying to open up, it's finding that it can't meet its requirements. I've looked at one hotel restaurant chain recently where it's ready to open, but it can't open at full operating hours because it just can't get the staff.
Another point just on the impact of COVID, Sally, obviously you'll be well used to the practice of applying a multiple to a maintainable earnings figure, and in calculating a maintainable earnings figure, you'll often use an average whereby you apply different weightings to different years. So a common one, for instance, might be to apply a weighting of 1 to 3 years ago's accounts, and a weighting of 2 to 2 years ago's accounts, and a weighting of 3 to the most recent year's accounts. To what extent are you changing that weighting, bearing in mind the difficulties that we are seeing with current management accounts and current figures, generally speaking?
Well, I mean, we apply a weighting in an attempt to assess what we think the future maintainable earnings of a business are going to be. So where there may not be business projections, then our best records are the historical results. And ordinarily, we would look to the most recent history as being the most representative of what's going to happen going forward, all other things being equal. But obviously, the impact of COVID means that particularly the accounting periods that sort of cover the March to June 2020 are quite severely impacted by COVID. So it's, although COVID is going to continue and going to continue to impact, it's unlikely that it's going to have that huge effect that it had in that first lockdown. So therefore, I don't think it would be right to, in all cases, to do the weighting most heavily towards the most recent year.
So what are you seeing in practice? Are you seeing that 132 for the most recent years, or 122, or 232, or?
I don't think it's probably as easy as that. I think it just depends on what's happened to the business and what factors have affected its profitability over those 3 years. I mean, the further back you go, probably the less reliant it is as an indicator of the future. So I don't think weighting's never as easy as that. It's really trying to understand what's produced those results each year.
So the weighting, like everything else, is an art, not a science.
Unfortunately, yes.
And obviously, once you've got your earnings figure, you've got to pick an appropriate multiple. And obviously, the multiple is often based on the comparable evidence or the transactional evidence that is available. Have you found that since COVID hit, there has been a lack of comparable evidence in the marketplace when considering multiples, and how have you dealt with that, if so?
Yeah, I mean, I think overall, the reported multiples don't translate into the drop that perhaps we were expecting to see. But there are obviously many reasons for that. If you look at the companies that are being sold, they're probably in the more attractive sectors at the moment in IT technology. And so that obviously has an impact on, sort of if you're looking at average multiples. And the number of businesses, the volume of transactions, the volume of deals fell particularly in 2020. So that, again, it may only be the better companies that are being actually transacted and sold. That said, there is still an appetite to buy businesses, particularly from private equity. So there, and again, the multiples overall haven't fallen as we'd expect them to do. There are still examples in the marketplace that we can use.
And in terms of, you referred to private equity, in terms of the funding of transactions, historically, my understanding is that the banks that may have financed those kind of private acquisitions have all diversified and are now too busy loaning money for COVID loans, and so they've diversified their own model and made themselves less available to finance the private acquisitions of day-to-day businesses. Is that something you found on the ground?
Yeah, absolutely. And I think there's also perhaps a bit of a reluctance from some of the private businesses to actually transact at the moment. They might, they'd rather wait until their own business is in a more stable state. And I think there's also the thought that perhaps a number of businesses are going to become insolvent, and they might be able to purchase those businesses out of some sort of insolvency proceedings for a much lesser sum at some point in the future.
So potential buyers are holding off, waiting for a better deal.
I think so, yeah.
And this flows nicely into my next question, which is, clearly there are going to be furlough schemes that people have been reliant upon. Government funding is reducing, and does the market expect a huge swathe of insolvencies where the inevitable has simply been delayed by the government's grants?
Yes, I think so. I mean, I think the number of insolvencies to February 21 were half the level of insolvencies in the year to February 20, because businesses were limping along. We've got this sort of new terminology with zombie business, which is just purely existing because it's relying on government finance in one way or the other. And when that stops, then there is, I think there's going to be quite a number of insolvencies. I think the banks particularly are holding off from making businesses insolvent at the moment. So I think that's sort of probably something that we're going to see in the future.
So we've got on the one side of the coin, you've got businesses who have benefited from all the government grants and actually perhaps made them a more optimistic proposition. Then you've got businesses who were probably teetering on the brink pre-COVID, but have simply been able to survive because of those grants, even though they aren't really a going concern once those grants end. Is that what you're expecting to see?
Yeah, absolutely. I think it's there are definitely winners and losers from the government financing.
And where we have these insolvencies that we're predicting coming forward, or certainly an increase in those insolvencies, are you expecting those businesses that have been able to survive COVID, and while all their competitors drop off, as it were, because they can't survive, those businesses actually end up having an upward bounce, or because they're the only ones left of competitors?
That's probably a difficult one, because the reason that some of those businesses will have failed is because of the sector they were in. And so I think the hospitality sector, for example, is still going to be suffering for a long time yet, because most businesses have taken a high level of debt. Obviously, those with little debt will be able to prosper, but I don't think it's a case of because some have folded that the others aren't necessarily going to reap the benefits of that. I think it might just be because they're in the wrong sector. I mean, again, if you take retail, the number of shops that have closed because of COVID doesn't necessarily mean the ones that have survived are going to continue to survive, because I think our habits have changed now. I mean, the growth in online retail has COVID has very much helped that, and I think that still then leaves all the retail shops, high street shops, in danger.
And we've talked about the kind of COVID effect on perhaps on multiple, perhaps on weighting, perhaps on earnings. How do you ensure that there's no double counting going on? There's no kind of double COVID effect, as it were, on your valuation exercise.
Yeah, I mean that. Well, you just have to make sure there isn't. It's a case of evaluating the risk going forward of COVID and where you want to reflect it in the valuation. So I think it has to be reflected, because I think it's an ongoing risk, not only in terms of the cash flow, but just of the sustainability of businesses, the change, the way that the market has changed, and the fact that we don't know. I think COVID's probably with us to stay in some form or other.
I'm going to hand over now to Miriam, who's going to ask some further questions about other important aspects that are affecting companies at the moment.
Thanks very much, Lynsey and Sally. Sally, obviously we've talked a lot about COVID for obvious reasons, but I'm guessing that Brexit is also having, or is going to have, an impact on businesses in this country and on their value. Are you able to distinguish the COVID effect and the Brexit effect? Or is it hard at the moment to distinguish between the two of them and the impact that they're having?
I think COVID has very much masked the effect of Brexit to date, and I think it's probably only now that Brexit is beginning to come to the fore, and we're actually able to see direct impacts of Brexit.
Are you seeing that the direct impact of Brexit is having more of an impact on certain industries and companies than others? Or are you finding that it's more widespread than that, or that there are particular themes that you're seeing, for example?
I think, as I mentioned earlier, I think that the initial thing that we're seeing is a staff shortage. I think a lot of EU workers return. I mean, again, it is interlinked with COVID in a way, because I think a lot of EU workers returned home at the start of COVID, and they're not now going to come back, which has meant that the knock-on effect in particularly I think it's sort of the fruit picking industries, etc., have lost their staff. And then we find that the hospitality sector staff who have been laid off as a result of COVID have now gone to work to take those fruit picking jobs, which means hospitality sector is now short of staff. I think there's also been a loss of skilled workers. the market is, particularly the construction sector, is really starting to suffer as a result of that. And I think there are the other problems that are beginning to see now are in terms of supply chains. We're seeing delays. Again, the construction industry, not only has it's got a staff shortage at the moment, but it's also got a shortage of materials. And in part, that seems to be because of Brexit, although there are other impacts.
And you're also seeing an impact on the marketplace. For example, a company selling, primarily selling goods or services within the EU. Are you beginning to see the impact of that yet in the kind of businesses that you've been working with?
I think it is. I'm not sure how long term some of those impacts are going to be. There's obviously new regulations. We've seen, I've got a business that I've been looking at that's not been able to get any of its normal supplies from Germany, which makes, which accounts for a large proportion of its sales. But whether that's a short term impact whilst we get the regulations in place, or it is going to be a longer supply issue, I think that's yet to be determined.
Is that the same with the supply chain issues, that those are short-term issues that are teething problems and need some resolving, and therefore arguably and I suspect this is the kind of thing you might be cross-examined on in court, that actually those are issues which aren't going to be long-term issues for a particular business that you're valuing? Or do you see the need to build those into the long-term picture for the company?
I think it's
company specific, but
it's a really difficult one because there are obviously going to be initial impacts. We've got new regulatory frameworks. We've got the fact that VAT is now being charged on goods coming into the UK, which has a cash flow impact as well as just another hurdle.
Yeah.
And people aren't quite sure of how things work at the moment. But there are other issues of whether Europe is going to want to continue trading to us, because it's a little bit more difficult to trade with the UK than it is to trade between France and Spain or whatever. So I think there is going to be an impact of that going forward. But it's trying to separate these issues out.
The short-term issues and then the likely longer-term issues which are going to remain. Yeah, because I think Boris and co would have us believe that they're short-term teething issues, but your valuations need to try and look to the short, medium and the long term. Is it fair to say that you're building in more allowance for risk in your valuations as a consequence these days? Yeah,
I think the businesses are, the profitability is a lot more volatile than it was. And there's some factors that are outside the individual business's control. We've got Brexit, we've got COVID, and it does make things more difficult.
Yeah. I wanted to ask you about China, because it seems that they've recovered from COVID, as far as we can tell from the outside, much more quickly than we and other European countries have. What impact do you think that might have on the global field, or you're already seeing in the companies that you're looking at?
We've seen quite a number of companies that obviously are sort of reliant on goods from China, where goods have been quite severely delayed. And I think that looking at that, China recovered a lot more quickly than the rest of the world and was producing a lot more goods, whilst the rest of the world was probably changing its methods of purchases. There was a lot more online retailers being established, and the supply chains became disrupted. So there was a huge demand of goods from China, but not to their normal places, to new places, which meant that containers were ending up in the wrong places. And the sort of businesses, I've sort of dealing with a couple of businesses that were sort of 2-month delays on their stock, and obviously with no stock, there's not a lot you can do. And I think that's now been exacerbated by the Suez issue, which had a huge effect, particularly on raw materials, which is now being flowed down into the production, and a loss of manufactured goods because they're still waiting for the raw materials. So again, those are really unusual factors, but things that have happened recently, which just throws another spanner into the works, I suppose.
Sally, is there an extent to which supply and demand comes into effect here, so that if you're not getting raw materials in because there's a ship that's trying to take the Suez Canal sideways, the materials that are available within the jurisdiction are going to become more scarce and more valuable as a result of that. Are you seeing a bounce, paradoxically, as a result of issues like that at the moment?
I'm in the businesses I looked at, I've probably seen the negative effect. I mean, I think the construction sector is absolutely buoyant in the US, and there, for whatever reason, a lot of goods are going to the US that would otherwise have come here, probably because the US will pay more, better. I've got contracts in place, but that's meant that raw material costs in the UK have increased, which has, especially on some of the construction sectors where they've maybe got a fixed cost contract, is putting pressure on the margins.
Yeah. Mm-hmm.
And also the ability to actually complete the job.
Mm. And presumably penalty clauses are coming into effect for the same reason. Yeah. Mm-hmm.
And Sally, what impact are you seeing from the increase in corporation tax? And where's it having the biggest impact, and how's it going to likely impact your approach to valuations moving forward?
Well, I mean, it's the impact is on the sort of, apart from businesses that will get the marginal rate, the larger businesses are going to pay 6% more corporation tax. So whereas, if you had £100,000 of profit after tax to pay out as a dividend, you're now going to have to pay a bigger chunk of that, or it'll be reduced by whatever, £6,000. So the dividends are going to reduce as well. And it's it's a big increase. I mean, we've had corporation tax at that rate in the past, but it is a big increase compared to where we were, and it's coming at a time when those businesses are also facing pressures from debt repayment.
So it's primarily a liquidity and an income issue.
I think so.
Yeah. Finally, from me, Sally, for now, I wondered, we've obviously seen fluctuating market forces before. It's not novel, and the family courts are used to dealing with them. Unsurprisingly, in 2008, after the financial crisis, the courts were faced with repeat arguments about the impact of that crisis on the valuation of businesses. How would you compare the current situation that we're in and the current crises with the financial crisis in 2008 and the impacts of that volatility?
I think it seems to be quite different. I think when COVID started, we look back to 2008, and we were looking at the way that multiples reduced then, and perhaps they were going to reduce the same way this time, and we could sort of see a mirror situation, but they didn't. What we did get is huge volatility, and I think the difference is that what we're in now is a very reactive crisis. It's changing, sort of by the month, and it's outside the control of the business, the financial world. So I think it is quite different.
Thanks, Sally. I'm going to hand over to Chris now, and he's going to take us on a different track.
Yes, although going back to 2008 rather touches upon that, because I'm going to talk about historic valuation. Sally, as I mentioned in the introduction, one of the things that the courts are asking for more and more is for a retrospective valuation at some fixed point in time in the past, typically when the parties were married or began to live with each other, so that it can assess the value of an asset that one party brought into the marriage and the extent to which that's increased during the marriage and the extent to which it had a value and a tangible benefit to one of them in itself. When you're asked to conduct that sort of historic valuation, what's your general approach to doing so?
I think it's very much fact dependent. The valuation, in the same way as we do a current valuation, is fact dependent. The business is probably going to have changed quite a bit from the previous valuation that we're doing. So we'd approach it as far as we can in the same way. But the issue we've got is we're looking back in time, and the further back in time we go, the less information that's available from which to carry out evaluation, both in terms of financial information, but also the narrative that goes with that. And so very often I'm finding that we can't do a valuation of the same scale that we can do a current valuation. It has to be a more of a lightweight, illustrative valuation.
Yeah. To what extent, when you're doing a current day valuation and an historic valuation simultaneously, to what extent do you think that you need to be consistent in your approach to the two valuations? So, for instance, if the right multiplier is 5 now, does it follow that the right multiplier in 2003 was also 5, to take a simple example?
Yeah, I would disagree with that approach. I think that the consistency is that we're valuing the businesses at market value. So, what a willing buyer would pay and a willing seller would be prepared to accept in an arm's length transaction. So, and a willing, those situations might be very different over the two periods. The company might be in a very different stage of its evolution. You might, it might be heavily geared at one point, less heavily geared at the next. It might be, low levels of profitability, high levels of profitability. So I don't think you can use, like you say, the same multiple or the same necessarily the same approach. I think both times you approach it as a market valuation.
And presumably you can take it one step further and simply say that you wouldn't even necessarily adopt the same fundamental approach to valuation. So, for instance, the fact that you valued a company on a net asset basis now doesn't mean that you would necessarily need to value the company historically on a net asset basis as well.
Absolutely. It's the market value, what someone would pay at that time.
Yeah. You mentioned some of the practical difficulties. How does, for instance, a lack of access to key personnel from 2000 or 2003 or whenever the valuation might have been, to what extent does that actually impede you from undertaking a proper valuation?
Quite a lot. I mean, we're trying to value the business based at that point in time based on its future prospects. We might have the historic accounts, and we have the accounts for the years after. But it's at that point of the valuation how much is known about the aspirations and the future success of the business potentially. So our orders in line, have they, if the new product, has it been launched, or is it in progress at that time? And it's all those sort of narratives and those discussions that you would ordinarily have as to where the business is today that you cannot really have. And people, going back in time, people's memories change and people's views of where they were at certain points is probably not very reliable, especially the further back in time you go. And some of the valuations we've been asked to do, have gone back to the 80s.
Yeah. Moving on to the question of the records, one assumes that the statutory accounts are going to be somewhere and accessible, if only from Companies House. Are you finding that companies are going to throw their records away for storage reasons and things like that, so that you are really not able to work with much more than the file accounts? Yeah,
I mean, sometimes that's absolutely the case. Companies only got an obligation to keep their records for 7 years, but beyond that, if you very often a company has changed its accounting software, so it might well have the backup, but they won't be able to load it.
Yeah,
and you won't be able to access it. So the information is very much limited.
One of the issues that we see discussed in some of the authorities is what's known as linear growth. So basically the theory is you start on day one that the company was created with a value of 0, and you finish with the current day valuation that might be, I don't know, £10 million, and you draw a straight line between those 2 points on a graph, and then you look at the bottom axis as a function of time, and you say, okay, well, if I want to value this company in 2012, the graph was there, and if I want to value it in 2003, the graph was there. What's your view of that approach to historic valuations?
As an accountant, I think it's overly simplistic. I think businesses very, very rarely grow in a straight line. you might, you might have a startup business, initial growth spurt. You might launch a new product somewhere along the line, again, initial and further growth spurt. You might sell a profitable part of the business, realize that profit. And so in your current valuation, that profit will have disappeared out the window somewhere. You might also have acquired another business during that process. So I think there's so many variables and so much goes on. I don't think it's a particularly accurate method.
Well, the adherents of the linear approach might argue, I suppose, that one day's work in the early months of a company's lifetime is of equivalent value to one day's work in the last 6 months or so. To what extent do you think that intangible factors like the trust that you might have in a supply base, the trust that your customers might have with you over 20 years, can be reflected in an historic valuation? And it occurs to me that one argument might be that you're evening out the intangibles and the tangibles when you simply draw a straight line between the 2 points.
Yeah, but what if an investment was made in that business at some point along that straight line, and it made a huge increase in the turnover of the business? What happened if a regulation comes into play that destroys part of the business? The management team will change over time. You might bring in somebody extremely good. You might have a warranty claim. You might have a legal case. And there's an element of, look, I think I can see the attraction and the simplicity of the method. I think it probably is difficult to actually apply in practice and be assured that you've got a reasonable value.
I suppose it comes down to this. As a cross-check to a bespoke valuation, a linear plot of a company's growth might be quite interesting. But I suppose if there is a difference of scale between an historic valuation and where you appear on the graph between point in time A and point in time B, then you would need to consider how appropriate the linear valuation is. Yeah,
very often when we do a historic valuation, we'll sort of map out the progress of the business from the date of our first valuation date to where we are now, and try and work out what's happened and where all the peaks and troughs are and how the business has developed over, and understand how it's developed. And I suppose, if you've got a stable business, you've got sort of steady growth, and that's showing through in the results, then maybe the linear, there is a linear relationship. I just think that it needs to be proved that there is a relationship between, rather than just simply assumed.
There is science to this art after all. Moving on from that, an allied issue is the question of growth and the time value of money. If you take a business and you conduct your valuation at year 2003 and it's £1 million, £1 million in 2003 is not the same value as £1 million in 2021. To what extent is it your function to look at what that £1 million might have done were it not retained within the framework of the company?
That would depend very much on our instructions, I suppose. I've looked back, and where we have, sometimes we're just asked for the historic valuation, sometimes we're asked, what would the equivalent value be today? And where we have been asked that, the way that I've approached it is to look at inflation, because effectively what you're looking at is an amount of money that someone would have paid at the first stage, an amount of money that someone will pay today, and it's trying to inflate that first value up to today's value. Yeah.
So what's I guess the answer might be it depends, but what are the measures that you might have in mind when you're looking at tracking the value of money in 2003 and 2011? RPI, CPI, some other factors?
I would look at CPI as the sort of simplistic one. It covers most sectors of the market and looks really at inflation. I think if you start to look at interest rates, interest returns on investments, then it becomes much more subjective. Yeah. Because it obviously depends, what investments and how you are going to use that money.
Might you be tempted by, for instance, the FTSE index or sectors within the FTSE index or something of that nature?
No, I don't think so, because I think if you look at it on the basis of you're looking at the value, you've already attributed a value to the business based on where the stock market was at both those dates in terms of growth, in terms of expectations. So what you've come up with a finite value. And what you're looking at is a difference in the monetary terms between those two dates. I think if you start to look into FTSE movements, then you're adding another something into it which has already been accounted for at the two valuations.
One of the issues that can arise is the extent to which the court should adopt the benefit of hindsight to an historic valuation. To take our 2003 example, a hypothetical purchaser in 2003 isn't going to know that the purchase that's being contemplated of a competitor in 2006 is going to be a resounding success, or for that matter, a catastrophic failure. A judge in 2021 will know exactly how that pans out. Where do you stand on the use of hindsight in historic valuations?
Well, I think what you're trying to achieve in a historic valuation is the increase in the value of the business, or the decrease in the value of the business, I suppose, over a period of time. So you have to be consistent in the approach to the valuation at both those dates. So we can't use hindsight in a current valuation. So I think it's wrong to use hindsight in a historic valuation.
I suppose, again, going the contrary argument might be that if you were working out simply what a purchaser would have paid for a business in 2003, that's one thing, and you wouldn't use hindsight in relation to that. But if you are trying to measure the latent value of the asset in 2003 that turned into the asset that you valued at £20 million in 2021, that's a slightly different exercise, and one to which hindsight might be more relevant.
I can see what, I appreciate what you're saying. I can see what you're saying. I think my caveat would still be that the latent value of the historic asset, you're not comparing it on a like-to-like terms with the value at today's date, because the value at today's date isn't taken into account what it might achieve next year or the year after. If we had hindsight and we knew that it was going to land a major order, etc.
Yeah. And indeed, if people knew exactly what a business would do, they'd either never sell the business in the first place or
dump it.
Sally, can I talk to the practicalities of this for the forensic practitioner? One of the arguments that we see is that the costs of evaluation are counterproductive, or at least need to be factored in somewhere along the line. When you're being asked to conduct an historic valuation as well alongside a present day valuation, does that basically double the cost, or is it a less intensive procedure and therefore costs less? How does it work?
It's a less intensive procedure, usually because there isn't the same volume of data. So it's usually a more lightweight valuation. Because we just haven't got access to the data that we would have in a current valuation, and it's also we're effectively valuing the same business within the same report. So we've obviously not got the issues of producing a whole new report. It's just a section within the report, and there it depends how far back you go, but there are some basics understanding of the business as it currently trades that can be reflected back into its previous trade. So it's definitely not a doubling of costs.
Thank you, Sally. I think Miriam has one or two more questions about the difficulties in valuing particular companies in various sectors. Miriam.
Thanks. Sally, the Court of Appeal has fairly recently recognised that there are limits to what you do, and that there are some companies and some circumstances circumstances and some sectors in particular where it's difficult or sometimes impossible to attach a reliable valuation to certain companies. For example, property development companies are particularly difficult to value. Looking at both historic valuations and current day valuations, how do you go about valuing and trying to attach a safe and reliable value to companies where it's actually quite difficult to try and reach an accurate valuation?
Yeah, I mean, property development companies is a very good example. And it depends very much on the size of the business. But if you've got a company that's maybe set up for a single transaction, it's part way through the transaction. The development, I think, in many ways, it's probably fair enough to wait till that development's been completed and see what profits have flowed from it. Then ask someone to do a valuation, because there are so many intangibles in there and so many judgments and so many assumptions that are made. I mean, we're not property experts, we're not surveyors, so in a property development, we're very much reliant on what we are going to be told in terms of sort of the waterfall projections that are going to come from that development. I think maybe sort of the larger the business, the more property developments it's carried out in the past, then the more confident we can be, because we can look at past results, we can look at past projections, measure those against actual results, see how close they are, see how successful it is as a property developer. And the veracity of the projections are often much stronger, because there'll be obviously lots of people, stakeholders in that development, all requiring some sort of certainty, or as much certainty as possible, as especially the recovery of cash. So it is a difficult sector, and we'd say we're not property valuers. We can only deal with the information we've got provided to us in those circumstances.
And I imagine you're rather relieved that the higher courts have taken the burden off you and said that sometimes it's not your fault, much like it's not their fault if sometimes a reliable valuation just can't be reached.
Yeah, I think absolutely. I think especially property development, presumably, because most of them are short-term developments. It's not as though you're going to hold on to the business for a long time. It's something that can be realised in a fairly short term.
Sally, that's really helpful, as has all of your extremely helpful answers to our questions. I hope being grilled by the three of us too unpleasant. I'm sure you've encountered worse in court, but we're extremely grateful for answering our questions with so much clarity and care. Thank you.
No, thank you. Thank you for asking me.
Well, thank you, Lynsey. Thank you, Miriam, and again, thank you, Sally. And most importantly, thank you to the viewers. We very much hope that you've enjoyed and learned something, possibly, from the first of our online seminars on this issue. Please join us again. Thank you very much.
Thank you.